Today on InvestTalk, we look at the CrowdStrike disaster and how it will impact their business. Then we look at today's market movements and we answer questions about Cenovus, Ovintiv, and Fortuna mines. Let's go.
This is InvestTalk. Independent thinking, shared success.
Now let's touch on our main focus point today, and that is about CrowdStrike and plummeting 13% after massive IT outages on Friday. And from the peak, this peaked out not that long ago. You're talking about July 9th, 13 days ago, less than 2 weeks. It was at nearly $400 per share. Today, we're at $263 and change on the close. The lowest level basically since the beginning of the year. The year started at $255, so it's still up on the year, but barely. Okay. And this is a company who has historically good, solid, consistent growth. Okay. You're talking about earnings expected to be up 29% this year, 22% next year. But those estimates are coming down because of this event. And what this shows you, first off, is how quickly a name with high expectations, trading at high multiples, can fall when there's a really bad news story that will impact the overall growth and profitability of the business. It's now off 33% from its high, but it's still trading at, even if you go by, next year is supposed to earn $4.89. Let's call that 5. Okay. It's still over a 50 times multiple because that's 263. Which is very expensive. That's after this drop. So that's lesson number one. If you're going to buy high multiple stocks, understand that this can happen swiftly. In an instant. Okay? So that's why these are high risk, high reward, right? If the trend continues, they can go up dramatically, right? This is a name that was at $95 at the beginning of last year. And it's at 263. So still, after this drop, that's still a wonderful return over a little over a year and a half. But what if you bought it in the past month? You're sitting on pretty hefty losses. So that's the name of the game here with all of these mega cap companies, large cap companies, with trading at 60, 70, 80, 90 times plus, forward-looking multiples. They're very, very expensive, very, very overvalued, and they are priced to perfection. And when perfection doesn't happen, things fall out of bed quickly. Okay. Now, this all happened on Friday, and since then, there's been a wave of Wall Street downgrades. It disrupted internet service across the globe, affecting many industries, airlines, banking, healthcare, and about 8.5 million Windows devices. You know what's interesting is that Southwest avoided this. It was the one airline that was not affected. Why? They're still running on Windows 3.1. And just a backstory here. That was my first computer. My first computer ever was a Windows 3.1 device. So it's obviously old technology that saved them. But if you were up to date on the newest technology, many instances you were having problems. Luckily, we internally at KP, we use SentinelOne, and they're one of the ones that have been beneficiaries. But there's going to be reputational damage here. It'll hit new customer contracts. Competition will heat up. And when you're selling, it's hard to sell when you're on your back foot trying to defend yourself after something like this that had such wide-ranging ramifications. And there's potential legal liability here. And there's a lot of uncertainty. So typically, this is the type of thing that said you buy, but this business is built on reputational integrity. And so you have to be very confident that they can bounce back from that. And I'm not so sure that they can when there's so many great opportunities or companies out there that do similar work as CrowdStrike. Now, in the next Invest Talk, we'll look into this story. Retirement plan changes, what the IRS update means for you. That story tomorrow, but for now, I'm Justin Klein, ready to take your questions at 888-99-CHART. Now let's take a look at the market today. It was a decidedly positive day after the big news over the weekend that President Biden was bowing out of the 2024 race. And it looks like Kamala Harris will replace him. And the markets rallied, I think, really on the backs of a belief that maybe Kamala has a better chance and that the current regulatory environments, monetary trajectory, fiscal trajectory, etc., will remain the same. Policies will be static, and markets like certainty. And when you have President Trump leading like he was going into the weekend, and JD Vance is his vice president, that was still very good odds of winning. That was a new regime that was potentially upon us. Now, I still think that the higher odds that Trump will win the election as of now. Now, things could change. I think Kamala has a better shot, but there's a lot of work to do if she wants to win. And so I think there's going to be a lot of market gyrations trying to handicap this situation. There's not going to be a debate until September, I believe. We have almost a month until the Democratic National Convention. So what will that look like? How much faith will she be able to put into the electorate? And what will the polls say once you get a string of polls as opposed to just a handful that we've seen so far? And so while I see the market's point here, which is, hey, maybe there's still the status quo possibility, I doubt that. I think this is still a rally to sell, especially in those mega cap names. And I think the dollar will roll back over as well, especially because you're getting closer and closer to a Fed cut in September. So that was the market today. I think it was a bounce, but it's not a bounce, frankly, that I'm having a lot of faith in, at least in the near term.
Hey, Justin and Luke. I had a quick question about stock SBSW. Sibanye-Stillwater. It's been on my watch list for a couple of years now and largely traded sideways for the last, about a year. I'm just kind of wanted to get your opinion on it. I'm having a tough time kind of getting a deep dive in on some of their numbers. I appreciate any insight. Thanks. Bye.
Well, it is a difficult one to get a lot of great information, and mainly that's because they are out of South Africa. And so their reporting figures, they only have to report twice a year. Their profitability is very negative. And the main reason is because of their exposure to palladium and platinum, and those have been down dramatically. So the way you want to look at this is a company historically, it's very up and down. It has booms and busts, and that means it's not a buy and hold investment. It is for a trade, okay? And if you want to play palladium and platinum going up, this would be a very levered way to do that. Okay. Now they are fairly diversified. They do produce some gold, nickel, chrome, copper, cobalt, etc., zinc, but mainly this is about that platinum and palladium and rhodium that go into catalytic converters, for example. And so that's why platinum and palladium have been down, because the market's saying, hey, everyone's moving to EVs. Catalytic converters are going the way of the dodo bird. But if you've seen a shift in the automobile industry as of late, a lot of these companies are pulling back from EV development and launches, mainly because just the demand is not there at the current prices. And so a lot of them are moving to hybrids, which means, hey, they still have an internal combustion engine and they still need catalytic converters. And so if you want to play that, that's what this is. This is a vehicle for that, because of its levered, because it's not very profitable now. But hey, platinum and palladium go up dramatically due to major price reversal. Suddenly, their profits will go up as well. So that's what you're using it for. Nothing else. A play on that trend, but it's high risk. Thanks for the call. Now let's go talk to a live caller, Greg in Seattle, and he has a question.
Hey, Justin. So I've got a quick question for you. I've got about $800,000 in a Roth IRA, and a couple of my largest holdings are Avantis index funds that have exposure to the big seven.
Mhm.
But then my second largest is S&P, and then about 10% in VTI. And as I'm looking at S&P and VTI, they're virtually identical in their top 10 holdings, but the S&P has outperformed it 5 years in a row with a far lower volatility score. And I'm just wondering if it's unnecessary duplication to have both, and if I'm better off diversifying what I have in VTI across my other funds.
Yeah, but I would probably be diversifying out of the S&P because there's that overlap there. And the reason that S&P has outperformed is over the last 5 years is and frankly, 5 years is not enough time to tell a difference. But it's really because VTI is more exposure to mid cap, less weighting towards those biggest names. And so they have outperformed, although, if the recent reversal is any indication, maybe that performance gap will close and go the other way. And I would say it's likely to if the dollar gets weaker and you get a more competitive domestic market for small and mid caps. And so I do think that you have better opportunities outside of the S&P, and that's what I would be selling is the S&P and buying some of those other funds to get you more exposure to mid, small, and leaning closer to the value side of the market.
Okay, wonderful. Thank you.
No problem. Thanks for the call. Now we're heading into a short break, and on the other side, I'll run down today's topics. Take your questions on the InvestTalk Anytime listener line, and the number is always 888-99-CHART. Let's go talk to Dan in New York, looking at CVE, Cenovus Energy Inc. Oh, is it James? Okay. James from New York, looking at Cenovus.
Yeah, I'm looking at Cenovus, looking to get some oil exposure. Do you believe it's fairly valued, and do you think this is a name that might have some price appreciation in the near term?
The chart is pretty solid. It is a large cap name, $37 billion market cap. It's one of the larger Canadian oil and gas names. I'm trying to remember, though, I don't know if you've done any research on this. We did. We picked a different Canadian oil name that has access to the new pipeline that goes out to the Pacific Coast. And we think that's going to bring a lot more profitability to a lot of these Canadian producers. And a lot of the large ones have bought up capacity on that pipeline. And so we're fairly bullish on a lot of those names in general compared to other oil names. And I'd have to go look and see if Cenovus is one of those. I believe it is, if I'm remembering correctly. So I would confirm that. So I like it. It was on our list, I will say, of ones to buy for our clients. Once again, we went with a different name, but it's good. It has reasonable valuation, good profitability, good balance sheet overall. Only about $4 billion in net debt on a $37 billion market cap. So pretty much none there. Enterprise value to EBIT is about 5 times, which is not the cheapest around, but for the profitability of 16% return on equity, I'd be more than willing to pay that. So it's a good name. I think there's a bit better, but you could do a lot worse. That's for sure.
Do you think that if it were to continue paying off debt, that would also improve its future share price?
Not really, because it's such a small amount already. I mean, they're not in any threat to go bankrupt or anything like that. Their free cash flow was nearly as much as their debt, right? Free cash flow was nearly $4 billion, and that's about their net debt. So they could go and pay off that debt almost whenever they want. What they're doing instead is they're paying out a dividend, and then looks like they're buying back some stock as well. So I don't think the debt is really an issue. It's so small. It's more about, can they continue to grow that cash flow, grow that earnings? And this year, unfortunately, earnings are supposed to fall 4%, but then go up 6% next year. So it's kind of flattened out there. But I don't think debt is not in my variables at this point because the balance sheet is so strong.
Okay, thank you.
No problem. Thanks for the call. Now, we have a lot of ground to cover over the next 40 minutes. Let's dig into China and their manufacturing struggles and how is that going to impact their economy longer term. And then lastly, Chevron deference. This is a big Supreme Court ruling that came down this year, and a lot of pro-business people are excited about it. But how excited should they really be? Because there's always pros and cons of everything. And we'll look into the cons of this overturning of Chevron deference and how it could potentially, lower profitability long term for many industries and many companies. So we'll look at that story. Okay. We also have voice bank questions. One is on interest rates, the other is on Anglo American Platinum. And we also have some questions submitted via the comment section on our YouTube channel. And of course, we welcome your finance and investment questions right now at 888-99-CHART. To talk to Chris in Atlanta, looking at Ovintiv, OVV. Do you own it or looking to buy it?
I own it, and I've been watching it. I own it for the fundamentals. It looks like it's fundamentally has, good numbers and all that, and a sustainable dividend. But it kind of feels choppier than a lot of the other oil stocks that I have on my watch list. I was going to see what you guys thought of this stock.
Well, the reason that it's choppier is because this is a company that has a lot of natural gas exposure. Okay. And natural gas has been weak as of late. And so that's probably why it's been underperforming lately. Now, there was some good news. I think it was over the weekend on more potential natural gas LNG exports coming online. And that would sop up some of the supply that we have plenty of here in the United States. And so that's really your issue is, do you want exposure to a more natural gas focused oil name or one that's oil focused? And that's why I think this is underperforming near term. But it's still a good business, or still a good company. So it's earned $7.16 next year. You're talking about a balance sheet that is pretty strong, about $6 billion debt on $12 billion market cap, enterprise value to EBITDA right around 4. So, it's a good name, return equity 20%, even with weak oil, natural gas prices. So I don't see any issue with it, frankly. I still like it. Is it the best in the industry? There's a lot of names, to choose from here. But I wouldn't be selling it just because of recent underperformance. That's just because of weak natural gas prices.
No, I appreciate it. I wanted to get a second opinion because I just kept looking at being choppy, and I was like, there has to be something deeper that I'm missing because it's on this. So I appreciate you clarifying that.
No problem. Thanks for the call.
Hey, this is Thomas from Santa Cruz. I'm calling asking about platinum miners. I know a lot of people have been asking on the show recently. I did a little bit of research, and I think that Anglo Platinum Miners seems to be the largest in the world. I wonder if that's one that you would approve of. Ticker symbol is ANGPY, I believe. They seem to have like an ADR as well. So I was wondering which one you approve to buy of, if any. I'll be listening on the show. Hope all is well.
Well, yes, there's an Anglo-American and there's Anglo-American Platinum. Different companies. This might have been, I'm assuming this is a spinoff of Anglo-American, but this is Anglo-American Platinum. ANGPY is the symbol, and it's the world's primary producer of platinum group metals. So platinum, palladium, rhodium, iridium, ruthenium, and osmium. Okay, and they also produce copper, nickel, cobalt, and some others, so fairly well diversified. But this is, once again, another potential play on platinum and palladium and the increase in price. Now, both of the charts of this and Sibanye-Stillwater are not great. They're trying to find a bottom, but no guarantee that they will find a bottom. But at least Anglo is profitable, even though that profit is coming down. So if I would say this is probably a better play, just because it comes out of Anglo-American. Historically, it's a well-run producer of that. I know Sibanye has gone into lithium, which is, if you've been listening to the show for any length of time, I've not been a big fan of lithium. So I would probably buy this one over Sibanye-Stillwater. But you have to get that turn in platinum and palladium. It looks like it's coming, but no guarantee, and that makes this pretty high risk. Thanks for the call. Now, let's get to a question that came in via our comment section on our YouTube channel. Matthew WP says, I was curious on your opinion on waste management, ticker symbol WM. It seems to have quite the moat and seems to be robust in the sense that no matter what really happens, trash will need to be picked up. Trading a P of 36 now, but forward P of 30 and has a dividend. One thing I was curious about was inflation effects on current stock price. I'm 19, so I have plenty of time ahead of me, and I'm curious on your guys' opinion on the business in the long run. Well, congratulations on starting your journey, your investment journey at a young age. But there's a couple of things that in your comment that are good, and one that is a lesson you need to learn. Now, the first is you're talking about an economic moat, and that's great. What you're talking about is a business that is a quality business, has a lot of barriers to entry, and is difficult to compete with because scale, IP, whatever it is, right? There's a lot of factors. If you go back and listen to our latest webinar on our YouTube channel, you'll get a rundown of some of the factors that produces an economic moat. So that's great that you're focusing on that. But then you go on to say, we're always going to need trash, right? Yes, and that's certainly true. But that in and of itself, just because there's always going to be demand for a particular service or a product, does not mean that is a great investment. Okay? Because every company can be overpriced dramatically to the point where future returns have been brought forward. That's what happens, right? When you have certain return on investment of the business, but the stock price goes up many multiples of that, and you have what is called multiple expansion, that's pulling forward of future returns. And the only way to bring those valuations back down to earth are two things. One is growth, right? Where, yes, it's trading a high multiple, but it's going to grow so much over the next 5, 10, 15 years that profit growth is going to naturally bring those multiples down. So that's one way. The other is simply correction in price, right? Stock price goes down. Now think about waste management. It's a very large company. It does nearly $1 billion. Oh, sorry, let me go to the chart here. It does $5 billion a quarter in revenue. It grew revenue 5% last year. Grew earnings 11%. That was nice. Grew revenue 5% year over year last quarter. I think that's what I said. Grew earnings 11% in 2023. So it's a good business. But is it growing gangbusters? Is it likely to grow massively when it already has very high market share? And are we going to continue to produce way more trash than we have in the past? Probably not. It's usually based on population growth, and we are getting some population growth in the United States, but it's not amazing. So I don't see where the earnings growth is going to come from over a very long period of time that justifies a 35 times multiple. Doesn't make sense. So you keep it on your watch list, but you wait for it to get into a reasonable price. Right? Forward-looking earnings closer to 20 as opposed to 30. That's at a price where I'd say, okay, that starts to get interesting. So, and then lastly, your other comment about inflation effects on the stock price. Inflation in companies like this typically is more of a negative long term due to multiple compression, but also it's highly capital intensive, right? All the trucks, all the landfills, all the workers that they're going to have to continue to bargain with, and being a trash guy isn't something that a lot of people aspire to. So it's hard to get workers, and so you have to pay them a lot, and they have a lot of power there. And so I think an inflationary environment is not necessarily great for them either. So keep it on your watch list, but not a buy at the current time. Let's go to Mark in New Jersey, looking at FSM, Fortuna Mining. Do you own it or looking to buy it?
Hello, Justin. Thank you for the wealth of wisdom as always. I'm possibly looking to buy it. I've seen the material sector pull back a little bit, so I'm wondering if now's a good time to jump in.
Well, we actually own this for clients. We've been picking it up when it was trading in $2 to $3 range. Now it's at $5.04 at the close today. And earnings are expected to go up 105% this year. Now only up 8% next year. So, this is a miner. It's can go up and down pretty dramatically. But, it's one of our favorite kind of small producers out there. Very well run, considering how small it is. And they have good growth compared to many. So if you're looking in the gold and silver mining space, I think this is a good small producer that is going to be much higher risk than those big ones, but we think it's worth it. So we like Fortuna Mining Corp. Thanks.
That's wonderful. Thank you very much. I appreciate everything you do.
Appreciate you. Thanks for calling in. Now let's talk a bit about China and the fact that they are trying to boost their manufacturing capacity, their industrial capacity. The only problem is they're not stimulating new demand. I don't know if you know this, but we are now importing more from Mexico than we are from China for the first time since 2003. Now, what's happening in China is they are realizing that their property bubble must deflate, and they're allowing it to deflate slowly. And they're funneling investment into new manufacturing capacity. But they're not finding the requisite demand to soak up that supply. And so there's rampant overcapacity across the Chinese industrial base. And what's happening is prices are being slashed and profits are being crushed. And this is frankly Beijing's only idea to accelerate this development of emerging and future industries to combat the slowdown, once again, in the real estate space. But it's wreaking havoc on Chinese profitability, Chinese company profitability. That's why the stocks continue to go lower. Right now, a quarter of companies listed in mainland China are now unprofitable. A decade ago, that was 7%. Now, they're trying to export more of these goods, and they were up 8.6% year over year in June, exports of Chinese goods to the rest of the world. But you're seeing a lot of backlash because what they're doing is effectively dumping these cheap goods on the rest of the world, which is hurting the domestic industrial base in those countries. And as a result, not just the United States, it's not just about Trump's idea of a 60% tariff on imported Chinese goods. It's other parts of the world as well. European Union recently increased tariffs on Chinese electric vehicles. India, Brazil, and Turkey all are pushing against Chinese imports with restrictions and anti-dumping probes. So this is something where they're trying to figure out a path forward, but they're kind of grasping at straws. And the reality is they're just not allocating money well at all because they have this view of just economic growth at all costs instead of what is economically viable and sustainable. And when you're building tons of electric cars, for example, you have 100 companies in China churning out twice as many electric vehicles as there are domestic drivers in China. That domestic drivers buy each year in China. So that means that they have to export at least half of those cars. And what that's causing is a major price war across those companies, and they are becoming less and less profitable. And so what's the end game? Well, the end game is these companies are going to go bankrupt. They're going to be swallowed up by Beijing and the party government. And they're likely going to force them to merge with bigger competitors. that are still able to be profitable. And this is actually what happened in Japan, and actually what hamstrung them for many decades post their bubble collapse was they, instead of writing off bad debt, letting big bad companies go bankrupt, they merged them into healthy companies, and they made the entire economy in general weaker, less efficient. And so the poor capital allocation in China into real estate is now coming home to roost. But instead of pivoting to a sustainable business model that, yes, maybe produces slow growth, they're only focusing on the growth side to the detriment of sustainability and profitability of their business sector. And so they're pulling forward that supply of manufactured goods, but they're not getting the return on investment that they would if they spread this out. They grew slower, more thoughtfully. I think of this, it happens a lot in the restaurant business. I've seen this many times here in the United States. A very common one, I remember in the 90s, Boston Market. It was a company it was a chain that was growing dramatically. It had a lot of interest, a lot of demand, and they just grew too fast. And it ate up all their profits instead of just growing slowly and keeping a sustainable business. Because they were just focused on some magical growth number. But in reality, every business should be focusing more on profitability. And not just profitability today, but how will this translate into profitability tomorrow? And unfortunately, Chinese government doesn't have a good sense of how to do that. So that's why the stocks continue to go lower. Let's go answer another question that was submitted over on our YouTube channel. Abmundi says, Justin, can I leave unused money in SGOV for 3 years? Is it a good or bad idea? Thank you. Well, this is SGOV, and this is actually an ETF that we're using as a cash alternative for clients. Why is that? It is a very short-term Treasury bond ETF. The iShares 0 to 3 month Treasury bond ETF. Expense ratio is only 9 basis points, and it has an SEC yield of 5.25%. Better than most money markets you're finding out there. We're finding out there. And it's very low risk because there's no credit risk because it's all treasuries, and there's pretty much no duration risk because its average duration is 0.12 years. So effectively 1 month. Okay. And we like that. We like that. Now, can you leave it there for 3 years if you want? Now, understand that rate is going to fluctuate. The Fed's going to cut rates in September. And guess what? The yield on this ETF is going to go down by about 0.25%. So you're not locking in this rate. You're not getting it 5.25% for the next 3 years. There will be a cutting cycle. Now, I don't think it's going back to zero, so I don't think this is going from 5.25% to 0% or anything like that. But, could this go down to 4%? Absolutely. If the Fed goes into, 4 or 5 cuts over the next 12, 18 months. So it's safe. But what we've learned over the past year and a half is that just because 5% sounds great, and this applies to all your high yield savings accounts and money market accounts, they sound great, right? Compared to history, this risk-free rate sounds amazing. But look at what you're getting in most other markets, especially equity markets. You're getting much better, both last year and so far this year, than that 5%. And so you're taking more risk, but you're getting better return. So that's where we're at. It's fine to hold it there if you want to be super low risk. Sammy from San Francisco, hang on. You will be next after this final break. So give me a call now at 888-99-CHART. Let's go talk to Sammy in San Francisco. He wants to talk about CrowdStrike.
Hey, Justin. Thanks for taking my call. Would like you to share your thoughts on this stock. It has come down quite a bit over the last couple of days.
Well, I just talked about it earlier in the show. I'm not sure if you caught that, but this is a company that was drastically overvalued going into this event, and now it's moderately overvalued, maybe shall we call it? There is some support here around 260, and it's at 263 right now. So you could get a bounce. The major support, though, wouldn't be until about 172, 175 in that range. And you really have to ask yourself, how much damage does this do to their reputation? They're the leader in the industry, but there are plenty of other good ones like SentinelOne and others. I think there's a good argument that this is going to drastically impact at least their short-term growth, and that could translate into hitting their long-term growth as well. So the salespeople there are going to be on their back foot for a little while, trying to justify this, justify the spend, and that they shouldn't go to another competitor. And that's why I don't think this is ready yet. I don't think this is a name that is cheap enough, that there's enough clarity for me to really get in at these levels. So I'm still passing on CrowdStrike. Thanks for the call. Let's go to Dan in Walnut Creek looking at OPRA, OPRA.
Yeah. Hey, Justin, thank you for taking my call. I appreciate it.
Sure.
Hey, back in March, someone called in and you spoke positively about this. I'm not too sure if you recommended the person buy it or not, but I bought a very small position to keep an eye on it. And since then, it's down about 19%. I was wondering what you think about this stock now.
Well, the technicals still are kind of neutral. I will say that they're not terrible. They're not great. It's been in a range here, like you said, since really this time last year, between, let's call it with the low end $10.50, the high end about $17. Now we're closer to the low end, around 12 and change. Nice update today, but I do like the profitability. Return equity 17%. They have net cash on their balance sheet. Their free cash flow is $61 million on a $1 billion market cap. So that's about a 6% free cash flow yield. And the only issue, though, is that earnings are kind of up and down. Earnings were $1.86 last year. It's supposed to earn 75 cents this year, 96 cents next year. On a $12 stock, you're talking about it. It's a low teens multiple looking forward, which is not necessarily bargain basement, but with the balance sheet, with that profitability, and for everyone else out there, what they do is they have a browser that is mainly built for gamers, for those in the crypto space. It has a built-in VPN, ad blocker, etc. And so there's a lot of tools that, if you're a power internet user, power gamer, power crypto wallet holder, for example, then you might be using OPRA. And obviously that's translating into a solid business, although that is up and down, and probably does have some correlation here to crypto in a way. So I actually like it as a play, just because the fundamentals are solid, the balance sheet's solid, and there's that definitely upside of this getting more and more adoption due to its focus on pretty important niches that are growing. And so I like that. So I'm going to give OPRA a thumbs up, but it is still very high risk, and it's still well above its lows. But I don't expect a breakout tomorrow. But this is a name that easily could break out at some point over the next 12 months. But it also could break down too if the growth does not materialize. So high risk name, only $1 billion market cap, small cap, but small caps are becoming more in favor. So I'm going to give OPRA a thumbs up. Well, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. It's InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.